Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, 13th of August, and yesterday's soft US inflation data is giving investors another dose of relief, lifting equities and bonds across the globe as expectations for an imminent Federal Reserve rate hike are easing today. AI optimism, on the other hand, adds additional fuel to this engine with CoreView and Nebius, two neo-cloud providers surging on explosive revenue growth and strong guidance despite widening losses. But the relief could prove short-lived as inflation remains above the Federal Reserve's inflation target. Oil prices are climbing again amid persistent Middle East tensions. AI spending is increasingly relying on leveraged balance sheets, and while borrowing costs in the US and elsewhere in the world are rising structurally. Hence, markets may be celebrating softer CPI today, but inflation, debt, excessively optimistic AI outlook, and geopolitical risk have not gone away. So we will talk about all that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So investors enjoy yet another, but probably temporary relief thanks to the subdued US data released yesterday. So yesterday's US inflation data came in exactly as expected by analysts. Both headline and core figures rose slightly in the month of July on monthly terms, pulling the yearly numbers slightly lower. The latter comes on top of a broadly soft US jobs data and wages data released last Friday as well, remember. So yes, the data is ideal, but the price pressures remain well below the Fed's 2% inflation target, still calling for a rate hike from the Fed this year, though the softish looking numbers both from the jobs and the CPI fronts buy time for the Fed to wait maybe a little bit longer before it hikes the interest rates. And the idea of a delayed Fed rate hike is giving a fresh boost to equity markets across the globe, along with strong positive reaction to the neo-cloud providers' strong revenue growth. In this context, Nvidia-backed CoreView, for example, jumped 20% yesterday on a 112% revenue growth compared to the same time last year. The company also raised its revenue outlook, convincing investors that its widening loss to pass $620 million US, which is more than double last year's $290 million US loss, was worth the revenue that it will make thanks to exploding AI demand. Same for Nebius, which saw its own stock price soar 34% yesterday after reporting its own results, suggesting that the FOMO, the fear of missing out on the success story of these neo-cloud companies, is not fully over just yet. Also note that the fact that these companies had sizable short positions against them into the earnings announcements also emphasizes the size of the positive moves that we saw yesterday, as the macroeconomic setup was softening Fed rate expectations on subdued data, also helping to lift their valuations by making the discounted value of their hypothetical future revenues higher today than with higher borrowing costs, obviously. So overall, and despite an early scare of seeing big technology companies' free cash flow levels plunge to low and sometimes even to negative territories in some cases during this earnings season, while the cloud providers, both traditional established ones like Microsoft and Amazon, and the newcomers like Nebius and CoreView come out of this earnings season with a smile, to say the least. Among the big players, Amazon and Microsoft also come out as the strongest links from this earnings season thanks to strong cloud performance in these companies. Microsoft especially, which was battered by investors for months for being one, a software company, and two, a big AI spender, was finally praised for not boosting its spending plans further, while Meta, with its nascent plan to build a cloud unit to lend out all that AI spending capacity that it might not be using for itself, remains the weakest link. Still, the chip makers, on the other hand, are coughing back to life these days following a harsh earnings season, to say the least, where strong earnings from these chip companies couldn't prevent a due correction. But if you look at the Kospi index, we start actually seeing the rebound in this Kospi index, which is heavy into memory chip makers, accelerate these days as investors are back to building long positions, convinced that the cheap valuations for SK Hynix and Samsung are worth taking the risk, as the speculative positions here have been mostly wiped out over the summer sell-off. And finally, as per the circular deal scare, the latest being triggered by Nvidia's latest $500 billion funding support from big Wall Street lenders to finance AI data center projects for its customers, while the latter helps somehow ease the company's CDS levels without, however, eliminating risk that if something goes wrong among the customers, the companies that Nvidia is lending money to, so that they can keep buying Nvidia's expensive chips and expensive racks, well, things would look ugly for its own revenue outlook too. But alas, for now, the good news is that these circular AI deals seem to be paying off. In the case of Microsoft, for example, reportedly up to 70% of its AI revenue has been generated by OpenAI. And while the Chinese rival DeepSeek warned earlier this month, remember, that it would raise the prices of its products significantly. We don't know how much, but they said significantly, giving some relief to the worries that the price competition from China would destroy the US company's profit margins and would somehow echo negatively across the AI bodies of the same circle. The bad news is that the whole AI economy now relies on the shoulders of two US startups, OpenAI and Anthropic, who have multi-billion dollars worth of deals with AI enablers such as data centers, cloud providers, and chip makers. And finally, as per the Chinese rivals, appetite in Hang Seng peaked in August on fear that AI spending in China as well has also started worrying investors. The Chinese technology companies will likely continue to see periods of boost and retreat on their technology progress, but they must make sure to keep their competitive advantage, the competitive price gap, wide enough to challenge the globally popular US rivals such as OpenAI and Anthropic. Zooming out, market mood has sweetened after the benign US inflation data pulled yields lower yesterday. As I said, the S&P 500 eked out a small 0.26% gain. Technology-heavy Nasdaq 100 gained 0.74% as the US 2-year yield eased below 4.20% after the data. Activity on Fed funds futures now assesses around 60% chance for a September rate hold from the Federal Reserve, as the probability of an October rate hike from the Fed now stands around 55%. That is not a lot, it's almost a coin flip. So the latter echoes positively across Asian bond markets as well this morning at the time I'm talking here, and US and European futures are looking in the green, but the softer Fed expectations on the other hand have been so far clouded by rising oil prices and have not translated into a softer US dollar across the board, in the sense the euro dollar sees resistance near its 2-month high levels, which also coincides with the year-to-date bearish trending channel top, while the dollar yen is still testing US and Japanese officials' nose a touch below the critical 160 level, keeping investors on alert regarding another potential US-Japan intervention. Now coming back to the US inflation data, as discussed yesterday, yesterday's soft inflation report from the US doesn't mean that the price dynamics are on a sustainably easing path. Because energy prices, which are mainly responsible for this year's heat up in inflation numbers, are rising again with no easy resolution in the Strait of Hormuz between the US and Iran. On the contrary, the latest news today suggests that Iran is shifting toward a more offensive stance, making the situation in the Middle East look more complicated by the day. As a reaction, US crude consolidates near the $83 per barrel level this morning, and that's around 24% higher than the July dip, with potential to rise further, obviously, as the US 10-year bond auction yesterday saw the highest yield since 2007. The push being driven by real yields, basically, which are adjusted for inflation, hinting that even if we filtered out the nascent and maybe temporary rise in inflation due due to the rising energy prices, while the US debt is costing structurally higher today. Blamed exploding debt and deteriorating confidence in US institutions, including both the US Treasury and the Fed, of course. As such, there is reason to believe that gold appetite around the world will return further. Moves in US dollar and US yields could interfere with the intraday moves that we see in gold prices, potentially pulling gold prices lower if they rise, for example, but the longer-term outlook for the yellow metal remains comfortably positive on the ongoing de-dollarization efforts globally. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.